Good afternoon, everyone. Thank you for joining today's presentation on the results for the first 6 months of 2021 to June 30th. So we'll just start with an overview on Headlam. Chris is then going to take us through financial performance for the first half. I'll touch on some of the operational performance that we've experienced, and then just update everyone on dividends and our capital allocation. We've of course had 2 appointments to the board announced recently, which we'll again touch upon, and then conclude our presentation with comments on current trading and summarise the points that we've covered as we've gone through the afternoon's event. So to begin with, Headlam overview and COVID. So just to remind you, Headlam's key competitive advantages sit around the fact that we are market leader in the UK, and the scale and national coverage is of vital importance in maintaining that market leadership. We have a huge, broad range of product, the broadest in the UK, and that's coupled with really good financial strength, which Chris will touch upon when he covers the balance sheet profile later on. Nationwide delivery enables us to provide, alongside that, with our distribution network and also our service centres, a very good collection service, which has enormous appeal to a certain customer group. And no business would be a good business without it being populated by great people who've displayed enormous loyalty over the years, and within which we have a lot of experts blessed with a great deal of experience and industry knowledge. Just across on the right, you can see some of the vital statistics. So we've been around now for 29 years. We have 21 distribution centres. Businesses total 66. We now have 54 trade counters, and we'll touch upon that a little bit later. Just under 25,000 customer accounts. Our commercial fleet is now 363, and if you'd looked at these vital statistics a few years ago, you would have seen that that commercial fleet number was in the mid-400s, and of course that reduction speaks enormously about our ESG, our growing ESG credentials, and of course how we're driving a much more effective and efficient improvement in our logistics. And then finally, supplier accounts, 184. And the key there is to form really strong relationships with those supplier accounts as we go forward. Touching on just some of the highlights from the first 6 months, whilst, if you cast your mind back, the UK economy was affected by a further closure of non-essential businesses in the first couple of months of the year. We have managed to continue, and whilst there was some impact, it was remarkable how shallow that impact actually was. And of course, once lockdown concluded, we did start to recover our top line growth, and the levels of performance started to move up towards H119 levels. And a lot of that reflects the tenacity and resilience of both our customer base and the strength of the business model. Full year expectations were upgraded quite significantly, and I'm sure most of you saw the RNS which announced that upgrade July of this year. And I think the most welcome thing probably amongst you all is we have returned to what we might describe as a more normal level of dividend payment, and there's no doubt that the operational improvement programme has delivered and will continue to deliver as we go through the second half of the year. So I'm just going to hand over to Chris now, who's going to take us through some of the key features of the financial performance.
Thanks, Steve. Afternoon, everybody. So just over the slide, just a summary and overview of the key attributes of the 6 months so far. As Steve said, the results shouldn't come as any great surprise. They're in line with the guidance we've recently provided to the market, and also, I suppose, show a really strong recovery back towards the levels that we saw in 2019 before the COVID affected trading that we saw in 2020. So I presented a few slides in this deck which will cover the key financial statements and also provide a bit more detail around some of the movements in revenue, costs and profit, but using 2019 as a comparator rather than 2020, because I think we feel that 2019 is more reflective of a sort of normal level of business. And although 2021 has still been affected by some non-essential retail closures early in the year, you'll see that the results have been following quite closely, actually, those of 2019. So we've used those as a comparator. So as Steve said, we're pretty much seeing revenue in line with 2019, and we will be presenting the numbers on a sort of continuing operations basis following the disposal of the Swiss business earlier this year. One thing which is a bit different on the second bullet point is this sort of continued movement towards the residential sector. We're not the only business, and many UK companies have been reporting those that face into the UK residential market have done very well, and that includes us, where we've seen quite significant recovery in the residential part of our business. And normally we would expect our business to be around 2/3 residential focused, 1/3 commercial. But because of these changes, it has moved a bit, and we've seen a real overperformance in residential and an underperformance in commercial sector. So although the numbers have broadly come out in line with 2019, there has been a bit of a change in that mix. That change in mix has in turn affected the gross margin on the third bullet point down. So we've seen gross margin level be a slight increase on what we've seen in the past couple of years. And that's covered in the bridge in a moment. So I'll talk you through a little bit of detail as to what's happening in gross profit and where that's coming from. But certainly that move towards the residential sector has caused some of that uplift in gross margin. The next bullet point down, where we talk about costs, we've effectively, again, kept a lid on costs and the inflationary pressures that we're seeing in the marketplace. We've been able to offset those with some savings elsewhere. So costs are relatively flat. And again, I've got a bridge which will talk us through the cost movements and the impact on what the bottom line as a result. Just moving further down the page, average net funds is a kind of key indicator for us. And we've seen that move into positive territory, and we've exited the half in a strong cash position. And that's something that's testament to the cash generative nature of the business and a real strong recovery from what we've seen in the prior year, which was heavily affected by the business closures that we saw in the first half of 2020. As Steve mentioned earlier, that's meant that we've been able to resume normal dividend payments, and I think also demonstrates the board's confidence and our confidence in what the future might bring for the business. So it's really important for us to get back on the dividend register as soon as possible, and the strength of the first half's performance has enabled us to do that. So just turning into a bit more detail, over the page, we've got a sales chart. Now, this is something that we regularly produce and talk to investors about. And in the past, it's traditionally always been relatively stable. And actually, the main purpose of this graph is to show the consistency and how the business operates on a seasonal basis. And the lines that you can see are normally quite tightly packed. Obviously, that changed significantly last year with the advent of the retail closures in the first half of 2020, causing that large V shape, and indeed the recovery thereafter. The light blue line represents 2021's performance, and you can see that that's also been affected in the first half by the lockdowns that we've suffered across the UK. And it caused, in part, the softness of trading that we saw in January and February, and the sort of catch up in that performance in Q2. So the results that we've seen more recently in June, July, are much more consistent with what we've seen before and are there or thereabouts with previous years. So it's been a bit of a different shape in the last 18 months or so, but it appears in the last couple of months to be returning to a bit of a more of a sort of normalized level of trading. So over the page, we have presented the income statement. So as I mentioned earlier, we are using 2019 as a more relevant comparative. So I've got 3 columns on this sheet, unusually, but we think it's a better representation. And you can actually see that those numbers are quite similar now between 21 and 2019. We've actually represented 2019 so that it's consistent. Following the disposal of the Swiss business, we're presenting these numbers on a continuing operations basis. So the numbers are like for like, and we can look across directly. The revenue and the profit and the costs, as I said, I've got some detailed slides and bridges in a moment. But I think a couple of things that are worth pointing out is this sort of gross profit percentage performance. You can see it is higher than we've had in the previous couple of years. And that is that residential mix change, but also some of the price increases that we've seen coming through. Shortly, Steve will cover some of the operational highlights or salient points from the business. And one of the features of the market, not just our market, but across the UK as a whole, is around the supply chain and the price inflation we're seeing in raw materials. And that's affected some of our purchasing as well. Now, as a distributor, it means that we're passing those costs on to our customers, and typically we do see a temporary uplift in gross profit as a result of selling out some of that stock that's now worth more than when we bought it. This slide is around the non-underlying items, so you can see that that's a £2.7 million cost in the year, and there's a bullet point which just explains that's actually a credit, an income of 0.9 of a profit on the disposal of the old Ipswich site following the opening of the new one last year, and also the goodwill and the amortization of intangible assets on some of the previous acquisitions that we've made. There is £1.5 million worth of cost in there, which is cash based, which is in relation to the restructuring costs following the completion of much of the reorganisation of the operational improvement plan. So we'll come on to talk about what that is and the elements that we've completed in the section that Steve covers later. So just over the page, these are the sort of revenue and profit bridges that I referred to earlier. And these are really helpful slides to talk us through what's happening with the business and what the like-for-like movements have been year on year. As I said, we've used the reference year of 2019 this time around because we think it's more representative of a kind of normal level of trading. So on the left-hand side, we can see a bridge that goes from statutory revenue that we reported in the first half of 2019 through to the revenue that we're reporting for 2021. Now, I've left in the Swiss business and the disposal of the Swiss business so that we can see the impact of that coming out of the numbers. And I think it's a really helpful bridge that talks to the UK and the European segments separately, so you can see what's happening in those parts of the business. But also it shows the true kind of like-for-like movements in the year and any impact of things like business days and also the currency movement. So it's a really good way of showing where the revenue is growing or declining and moving. And then indeed, the biggest item on that bridge is the removal of the Swiss business so that we can present our figures on a continuing basis going forward. On the right-hand side is the profit bridge that I mentioned, and this is segmented into 2 parts. You've got the first part at the top of the page, which bridges down to gross profit, and then the bottom half of the table covers the costs so that you can then reconcile back to the operating profit that we've reported in the income statement. Again, that table is presented on a continuing basis, so it excludes the impact of the Swiss disposal. And it shows that the volume shortfall, so that's sort of that like-for-like reduction in revenue against 2019, although relatively modest, did have a negative impact on gross profit. But most of that has been made up for by the mix change that I referred to earlier, as we've moved more towards the residential part of our business, which typically comes at a higher gross profit than commercial, and also the pricing benefit that we've enjoyed through the price inflationary nature of the buying over the last quarter in particular. So that's made up for that most of the shortfall in the gross profit through the volume reduction. So at the gross profit level, that means we're only £500,000 off where we were in 2019. And as we move down that table on the right, we can see the various components of the cost movements. And this is where we can see the in-year benefit of the operational improvement plan, which is 1.5 million. And that number we expect to grow as we get the full year benefit of the actions that we've taken earlier, and also the actions that have been completed in and around the half year, which will give us further benefits for the full year. So that number should grow. We can see that the benefit of that has offset the cost inflation we've seen since 2019, and also some other incentive-related costs that we've incurred in the first half. So it's meant that sort of protection, if you like, of costs has enabled us to report an operating profit very similar to that we saw in 2019. So over the page, we talked about this being a highly cash generative business, and has been for many years. And this cash flow statement, again, I've put the third column in there for 2019, so we can see a sort of more normalized level of comparatives. A couple of things worth pulling out on here, I suppose, starting with the cash generated from operations, which is being reported at just under 8 million here. Just as a reminder, that includes the 12 million payment of the deferred VAT from 2020. So if we sort of notionally adjust for that, that 8 million becomes more like a 20 million pounds cash generated from operations, which is, again, a strong performance when you compare that against our operating profit, and is more in line with that we've seen in 2019, and demonstrates this sort of strong cash performance of the business. The other thing worth picking out in this table, and it does cover quite a few of the notes in the RNS and the primary statements, is that the nature of the disposal of the Swiss business, it has to be accounted for in almost two parts. So as we've reported, we disposed of the Swiss business for around about £12 million worth of cash. That was actually done as two stages. So there was a sale and lease back of the property in Switzerland, which then was immediately followed by the disposal of the company. So when we present the statements, that comes through in a number of ways, and the accounting for that has been quite tricky to run through, but it has meant that we ended up with quite a large profit on sale of the property, and then it's had to be stripped out of the cash flow statement in the way you can see. And then further down the cash flow statement, you can see that there's been a cash inflow from property disposals rather than from disposal of the company. So it's just how it's been accounted for in the results, but it's meant that the £12 million of cash that we've had from the Belclaw disposal was largely has come through the disposal of the property. The only other area that's probably worth picking out on this slide is around the capital investment line. So we've shown in here, we've got 3.4 million of spend in the first half. That looks low when you compare it to the other years, but the other years have got the, I suppose, the one-off investment in our new Ipswich distribution centre, which exaggerated the cash outflows in those 2 years. And the 3.4 million is, I suppose, just maintenance capex, but it is at a slightly higher rate than we would normally have shown in the past. That reflects our desire to be more proactive with our capex refreshment. So things like plants and equipment, and some of our kind of key operating plant that exists in our distribution centres is towards the end of its life, and we are moving on to a more sort of refresh programme of that capital. So we do expect that capital spend to remain at a higher level than has been seen in the past to reflect that. Just over the page, again, we talked about a sort of a strong balance sheet. What does that actually mean? So the balance sheet here, we can see relative consistency between years. Inventories has remained relatively static, and that's despite the supply chain issues that we've seen and the whole of the UK market has seen following Brexit and raw material shortages across the world, really. And that's testament to a couple of things. One is that over the last 2 or 3 years, we've really worked hard at improving the quality of our inventory, so that we've been moving away from and minimising the amount of slow-moving stock, or bronze stock as we call it, and we're in favour of buying more good quality, fast-moving stock in the gold categories or silver categories. So that rebalancing of our stock has been happening over the last couple of years. And it's meant that we've been able to have a resilient stock holding in times of challenging supply that we've seen in recent times. The other aspect on the balance sheet you can see further down around the trade and other payables and borrowings is that's where that sort of big change around happened in 2020, where we had to lean on our facilities as working capital unwound. And then as we've resumed normal business, there's been a restoration back of the sort of trade creditor balances and a more normal level of trading. So we were able to utilise our facilities in the way they were designed to be last year, and now we've returned back to normal. We've seen that sort of unwind of working capital accordingly. What it's meant is that we've exited the half year in a strong net funds position of over 50 million, and that of course includes the funds from the disposal of the Belcolor business. So that's also been enhanced by that income. Banking facilities remain strong and largely undrawn, and those facilities are in place still for a couple more years. So over the page, we show this slide very regularly, which just shows the granularity of how our net funds move on a weekly basis. And again, this is one of those slides which shows remarkable consistency until last year, and then we saw a change in the way in which our net funds moved. If you recall, the unwind of the working capital position in H2 last year and H1 continued this year, it accounts for the fact that the red line at the bottom left was where we leaned on our facilities during the COVID period, and then the unwind to the right-hand side of the page has continued in the first half this year. The second thing which is worth pulling out is that we have effectively moved to a normalised method of paying creditors. So typically we'd see a big outflow in January and July each year where we pay our creditors. We've moved to a more normalised payment profile, which accounts to the fact that there's very little cash outflow in January. It's more of a monthly flow, and we should see that going forward. A couple of things just to note, sort of post-period end, I suppose, is that we've disposed of a further distribution centre in Bedford, which has generated just under £6 million worth of cash. And also we've announced the proposed interim dividend, which will lead to a dividend payment of just under £5 million in the second half. So that sort of brings us to a close on the financial side. So I'll just hand back to Steve, who's going to give you some of the kind of key features from the operational performance.
Thank you, Chris. Okay, if we just turn to the next page, key features of the operational performance in the first 6 months. We obviously needed to readjust our working practices at the start of the year to cope with the lockdown. But I think what was really good was that having experienced it in 2020, we were far more prepared for it and were able to deal with it more effectively, as indeed were our customers. What did shine through was the tenacity and resilience that are quite evident amongst the customer base. And despite seeing overall revenues down, I think we managed to get through that period in quite a successful way, particularly given that non-essential retail remained closed until April. Two features that have arisen, one which Chris has already touched upon, and one which probably is a direct consequence of some of the changes that occurred in the aftermath of Brexit. So we're all very familiar with the fact that HGV drivers are in short supply. In fact, the latest statistic I saw earlier today was suggesting the shortfall was now touching 100,000. And clearly, part of that issue has been brought about because of Continental drivers repatriating themselves back into their home territories. We don't have a particular issue at the moment. We have a full complement of drivers, but what we've got to ensure is that when we head into and through the all-important Q4 period, that the driver shortage doesn't create an impact on supply and service issues with our customers. We have had price increases, which, whilst they continue to move through the UK, and there's quite a wide range, as you can see, 3 up to 14%. We are passing them directly into the marketplace. There isn't resistance, and it's just a function of supply and demand. Rather like the drivers, if there is a shortage on supply and there is the demand there, ultimately it goes to price. And during the first 6 months, we've continued to focus very strongly on improving the underlying position of the business by implementing a number of the programs under the Operational Improvement Programme. So next slide, just to give a little bit of colour on that. So why are we doing the Operational Improvement Programme? Well, it's quite straightforward. We want to improve our service propositions. We talk about to each customer segment. If we'd been speaking, 2 or 3 years ago, we would have probably only highlighted 2 key groups, which were the traditional retailers and the tradespeople, particularly the independent commercial fitters. And what we have done, and for the first time last year, we have undertaken a customer survey. We've now repeated it and supplemented that with work with individual customer groups. And what's quite clear is that the market is populated by a greater number of distinct segments, which a few years ago we wouldn't have been talking about. So we are gradually seeing more progressive retailers enter the marketplace. There are the larger contractors who've always been around, but one that we're trying to appeal to in a much greater level now. And then, a particular part of the economy which is very active at the moment, which is the house builders, both large and small, multiple retailers whom we have been active with, but we're wanting to extend the number of key accounts we deal with. And of course, the all-important online business, which is growing at quite a reasonable rate. And you can see, as you move across that continuum at the bottom of the page, that we go from being very high on the radar with the traditional customer base to being reasonably okay with the middle group, and then significantly underweight as we move across to the right-hand side. And the idea there is to capture a larger share of what we estimate to be a £3 billion market, and that will help in a significant way to fuel the future revenue line of the business. We are constantly looking at how to improve the efficiencies in the group and remove complexity, because we all know that complexity in a business environment costs money. And even though we've moved considerably through, as we'll see on the next page, improving our logistics and our network profile, that doesn't mean the end of the road. We'll go around that improvement program again, and then again, and then again, because the idea is that by keeping on honing that down, that will in large measure go to underpin the inflationary costs that as a business we would expect to incur as we go through each year. We've done a lot of work on modernising our processes and our systems, our data collection, the use of data to enable us to improve the quality of the business overall. And of course, we've done quite a bit of work to ensure that the working environment, particularly with COVID still being with us, is a safe place to be. And ultimately, we're doing all of this because we believe we can deliver significant cost savings, which, when allied with the work we're doing elsewhere in the investment programme, will go towards improving that operating margin as we head into 2023. So over page, we've highlighted for you the constituent elements of the improvement programme, and touched upon transport integration, which is 70% complete. We've done the north, we've done Scotland, we've then moved to the southeast because of Ipswich, and what will happen is we'll come back to the Midlands early next year to complete the program. And then, as I said earlier, go back out and repeat the process. So, this idea of continuous improvement will become deeply embedded in the organization. So the network consolidation was principally based around Ipswich coming alive and allowing us to relocate 6 businesses into that area. You'll be familiar with the fact that we already have trade counters in the business, but we've reformatted our approach to trade counters. We believe that there's a wonderful opportunity for us to increase our traction into the marketplace with a particular kind of customer who finds the availability of a trade counter very helpful. And the intention is for us to move from the current 54 up to 90. It will be over a period of time. It's not going to happen instantaneously, but as that comes on stream, it will give us a very attractive avenue for future revenue growth. E-commerce, as I said earlier, it is here. We have developed our B2B platform such that it's become more transactional, and we're going to supplement that to help the mobile customer with the launch of a new app later this month, which again is very transactional, it's very practical, it helps the individual whilst they're on the move, and ought to be a huge aid in allowing them to deliver the service levels that their customers are expecting. What goes hand in glove with re-evaluating which customers we're choosing to serve and how we want to serve them, looking at our sales force, looking how effective it is, looking at ensuring that the sales force is able to support the customer's need, able to support the service proposition that our end customers want to deliver to their customers. So we have reorganized the sales force. That's now up and running. And again, it will give us further revenue generation opportunities. We have touched upon customer propositions, multiple retailers, or what we would refer to as key accounts. We have established a dedicated team to man this particular development in the business. We did have well-established and large customers in this space, but already we're starting to win new customers. And I think the excitement here is that whilst we've only landed a few limited SKUs with these new customers, the potential for further growth is very obvious and definitely warrants the attention that this particular sector is receiving. And then, we are looking at our stock holding. That sits hand in glove with our supplier engagement. You're probably familiar with the fact that we do categorize our inventory now into gold, silver, bronze. Not surprisingly, gold goes out the door as soon as it comes in. Silver follows it not very soon afterwards. And the point about supplier engagement is to make sure that we do have a plentiful supply of gold and silver in particular, so that we can offer the kind of service that our customers expect. We're just looking to improve on that all the time. So just a reminder, we're on track to achieve ambition of 7.5%, and the landing date will be during 2023. So all important dividends and the capital allocation priorities that give rise to what we do with the cash. Clearly, maintaining a strong balance sheet is very high up there, and as Chris has demonstrated earlier, we are sitting on a strong balance sheet. It's not just by accident, and it is our intention to return cash at some point, but in the near future, I think it's far more prudent for us to have the firepower, because there are still a number of risks out there. COVID's still with us, as I've touched upon. Brexit is still affecting the UK economy. And, I think we need to have the business in a place where it can react to unexpected risks. Once we do return to a place that we can call normal, then obviously it will require us to go through our priorities and deal with the outcomes accordingly. But, first up on the list has been the restoration of dividends. We did make a nominal payment earlier in the year. We're now moving into business as usual calculations. And the dividend calculation is very straightforward. We want to retain 2x cover ratio because we are investing more in the business. There will be a high weighting on the final dividend because second half performance is traditionally stronger than first. But I think the most important thing is that we have returned to dividend, and we expect to be paying 5.8p per share come November this year. Over the page, you'll all be aware that we strengthened our board this year. Simon King already joined us, appointed in May. Simon has extensive experience of commercial environments, and he brings a very welcome range of experience to our board. And of course, Stephen Bird will join us later this month. Currently Chief Exec of Vitec, and again, Stephen's active role as Group Chief Executive of Vitec brings much needed commercial experience into our boardroom environment. Okay, so current trading. You saw the chart earlier that Chris referred to, which tracks our daily sales. You will have seen that as we headed into July, the light blue line was just converging a little more strongly with what we saw in 2019. If we'd extended that with the information we now have for August, it would have dropped below 2019. And the single standout feature there is that the commercial sector, as we've reported in the RNS, remains a little more subdued than the retail sector. And for August in particular, it was the absence of refurbishment within the educational sector that was really the cause of that dip. But despite that, we're still very optimistic about continuing to trade in line with the expectations that the market has for us. And if you recall, expectations that we increased quite significantly in July. And just a slight note of caution, I have pointed to the fact that there are headwinds. We do need to deal with those headwinds, but in the absence of unforeseen circumstances, there's no reason for us to doubt that we can't deliver during the second half, and of course, ultimately restore the dividend to where it needs to be. That's it. Thank you very much.